The stock market is looking pretty rough right now, but you obviously already know that, and that's why you clicked this video. Now, the question that we all have, of course, is where do we go from here? Is the crash going to continue, or are we going to see some type of recovery? Well, in this video, we'll go through the data and figure it out. And there's a theme of this video. You're going to hear about it a lot, and it's breadth. That's the theme. Something we've been talking about for weeks and weeks now. And finally, what we've been talking about is playing out. So let's start off with the Russell, the small caps, to figure out what's happening in the market. And as you could already see, it's had some rough days, straight down. And I'm looking at the futures right now because it's early morning and it's already down 2%. And you can see it is just about breaking its lower support line, which is not a good sign. So did we know this was going to happen? No, of course not. You can't know for sure that anything's going to happen in the market, but we were talking about the high probability of this happening. And we're going to jump into this research to show you why. And remember, all of it comes from Macro Ops, our global macro research and consulting firm. So we do this stuff all day. That's why we have this video for you every week. But you can see right here, here's the Russell. And here is the breadth of the index. And you can see breadth was going down as price was going higher. Now, what is market breadth? Basically, you're looking at how many stocks are going up versus how many stocks are going down. And the idea behind tracking something like that is that you want to see most of the stocks moving together higher. Because if you have something where, say, only 20% of the stocks are carrying the index higher and 80% are actually falling or not doing so hot, that means that that price increase that you're seeing with stocks, it's probably not going to last. So breadth is almost like a leading indicator, which is why we were tracking this. See, the Russell was going up, but again, breadth going down. And when you see that, when you see breadth deteriorating while price is going up, that's when you start saying, hey, this trend is becoming more and more fragile. And you've heard us say this week after week, that the trend is fragile, it's fragile, it's fragile. Now, when we said that weeks ago, it didn't mean that the market would fall right away. Because again, you can't predict exactly when these things will happen, but what you're doing is establishing general conditions. So my favorite example to describe general conditions in a market, and this is a big macro topic, right? Because general conditions are kind of tough. They can be around for a long time and nothing might happen until it finally all happens at once. So an example of a macro theme that's been around forever is China collapsing. It might be another 10 years before China collapses, if it does. But then you could look back and say, hey, all the general conditions were there. The high debt, the ghost cities, all that stuff. So going back to my favorite example of explaining it is imagine a boulder at the top of a cliff and it's on the very edge of the cliff. Now, if you saw that, what would you think? Okay, that boulder is eventually going to fall, right? Because the general conditions of it being on the edge of a cliff, it's like, yeah, maybe a gust of wind knocks it over, maybe a rainstorm, maybe a little earthquake. Doesn't actually matter what the triggering event is, but the general conditions were there for it to happen. Which is why even when you look at the news of like what they're saying, why this crash is happening right now, or any down move in the market, the actual event they attribute it to isn't that important. What's more important, again, is what's happening in the background, the general conditions. And Jesse Livermore talks about this all the time in that Reminiscence of a Stock Operator book, which is a classic. So when you're looking at breadth and you see this divergence, it's once again giving you those general conditions. Trend fragility being there for weeks in a row doesn't mean it's going to collapse right away, but when it does, you're not going to be surprised, which is why we're not surprised with the action that's happening in the market right now. Now, diving into a bit more of the analysis on the Russell, which we were doing, there's three technical forces that are always at work on the tape, and the tape is the price, right? First, you got trend, then you have momentum, and then you have mean reversion. Those are the three forces in the market no matter what. Every type of price action that you see falls under one of these three. So these forces work off feedback from one another and all affect each other. Momentum drives a trend to overextension, which kicks in the force of mean reversion and tips that momentum into reverse. That's why we have cycles in the market, right? It just goes like this. And during different parts, you'll see different versions of trend and mean reversion. So back in the beginning of this year, we were talking about the extreme extension in small caps, which you can see it better here as this massive run. And while that was a great sign of longer term strength, an extension like the one that we had historically led to reversion over the short to intermediate term. And now what have the small caps been doing with the Russell? They've been trading in a tight sideways regime for the last 5 months after they hit their largest spread from the 200-day moving average in history. And why do we even look at moving averages? Because again, it's giving us data on the mean reversion. So when we talk about the largest spread from the 200-day moving average, what are we looking for, or what are we expecting? We're expecting it to revert to that mean. That's why we have these moving averages. That's why we use them. So in this case, we went from trend to momentum, which was this massive extension. And now we're at the mean reversion stage, which is why you're seeing this action right here. This is all mean reversion. Until now, we might be seeing a break below. That's why this is a very important line. And you can see right here, this red line shows the largest price to 200-day moving average spread in the history of the Russell. And you can see this chart goes all the way back to the 80s. And we're going over all of this right now so you could see the analysis process. So it is playing out, markets are falling, and the Russell in particular, like I said, breaking this line. But we're trying to figure out how we got to this point so we could see where we're going. So continuing with the Russell analysis, what we saw was a major compression. So one of the ways to look at compression in a market is with Bollinger Bands. And another thing, we talked about mean reversion, trend, and momentum, right? Another principle of markets is compression and expansion. If you're thinking about a breakout from a pattern in technical analysis, what is that really? The pattern is the compression and the breakout is the expansion. So that's what markets constantly move through, compression and expansion. You'll see that over and over again. Now, the thing with the compression is that you don't actually know which way the expansion will go. So the breakout could be higher or it could be lower. So once again, when you're looking at this, what we called mean reversion, it is also compression. It's the market moving sideways and coiling. And what we might be seeing now is that breakout to the lower side, so the expansion lower. So again, another way to look at expansion and compression is with Bollinger Bands. And what we saw with the Bollinger Band width was that the Russell was one of the most compressed it's ever been. So the Bollinger Band width has been this compressed only 3 other times over the last 10 years. And each instance preceded an expansionary regime, aka a trend. See how this all fits together? So like a wound up rubber band with stored energy, compression regimes like these lead to expansionary regimes, so big trends. And the red little rectangles here are marking every time it happened. And you can see it fell here, launched higher here, fell here. Here, looks like it's gonna fall. So the Russell was testing its bottom Bollinger Band for the 6th time over the last 5 months. Now there were 2 ways to look at that. One is that 80% of breakouts from trading ranges fail in reverse, so we should expect this one to fail too. Or the Russell is retesting its lower Bollinger Band just 2 days after the last failed volatility breakout, a sign of budding weakness. You can see it tested it right here, and then it came back to test it again. And this is the 6th time. And like we said, they're in a major compression, right? And now we're seeing it break below. And this was all going on at the same time that our short-term breadth indicator, remember the other important thing, was at its lowest point. So the 5 other times that the Russell was testing that line, it didn't have breadth as bad as it was this last 6th time. Its current breadth was at its weakest level since the COVID bear market. So you can see why that adds to the probability of the breakout actually holding and this falling further. So all in all, it looks like we're in for some more downside here. And we really focused in on the Russell just now just so you could see the analysis process, but this kind of applies to the entire market and it fits into our summer doldrums theory, meaning that this summer we're going to see a lot of sideways volatility and chop in all of the indices. And that thesis that we talked about a few months ago came down to the same factors we're talking about now. So we were seeing signs of heaviness under the broader market because things like breadth were showing weakness. They've been showing weakness for a while now, which is once again why we've been waiting for this. And our own proprietary indicators weren't looking so good either. On top of that, we were seeing the highest level of global equity issuance since the great financial crisis. And not to mention, we're running into a wall of SPAC and IPO lockup expirations in the coming months. So what that means is that a wave of supply is hitting a heavy market. So the market's already heavy and then you're adding a bunch more supply. And remember, what do the markets come down to? Just basic Econ 101. They come down to supply and demand. So if you have a fixed amount of demand, let's say we do right now, and you add more and more supply, what's going to happen to prices? They're going to fall, right? Because now there's too much supply for the amount of money that's chasing it. What you would like to see if you want prices to move higher is a bunch of demand and a small amount of supply. So a bunch of money floating around with just a few stocks that people can pile into. You'll see those stock prices shoot super high. Right now, the opposite is happening. And all of this is also happening during the market's weakest 4-month stretch of seasonality. Summer is usually rough as it is. See the 20-year average here. July is actually the best month, and things don't really pick up until the fall again. So the odds favored our call for sideways volatile chop through the summer. And if we're getting that, which it looks like we might be now, it's going to frustrate a lot of people in the market to the point where we'll finally see a significant reset in crowded over leveraged positioning. And this in turn would set the stage for a strong rally into year's end. So positioning, that's another thing we always talk about, right? So right now everyone is super bullish, meaning sentiment is really positive, and that also leads to people having most of their money in the market. That's the positioning. Now that's actually not good for a bull market, because if everyone is bullish and everybody's already in, how much money is on the sidelines still left to come into the market? Because you need that constant buying pressure to push prices higher, right? What you rather have is a bunch of bearish people, because then that gives us more fuel for the fire because they still got to convert. So a rough summer would be great because it would reset everyone's view on the market. They wouldn't be so bullish anymore. And then in the fall, because yeah, we are still longer term bullish, the fundamentals are still solid, liquidity is still flush, that's when we could see that rally into the year end. Now moving on from the Russell, we could go back to the S&P and let's figure out what's happening here. Well, initially we had a target after it broke out from this range right here of 4,420. So the S&P actually made it within 66 basis points of that measured move. And then what happened? We're seeing it fall now, right? So a retrace back into that previous range that we were talking about would indicate a bull trap, and it would put odds in favor of a low to sideways summer doldrum market. So yeah, that zone might be a little hard to see right here, but fortunately I am very artistic and drew it over here. So you can see we're getting pretty close to breaking back into that range. Now again, this is pre-market futures, but it looks like we're less than 1%. So if it breaks into this range, that's the big signal for you. That means we're gonna have a volatile summer. It's gonna suck. Well, it'll suck for a lot of traders. Not us in particular. But by the way, hopefully you got my email this weekend. Our alpha rotation system issued a big signal. It's the first one in a long time because the market has been kind of crazy, prices going up, but breadth being so bad. Now the signals are finally aligning. So if you're not using that system, just shoot me an email and we'll get you set up. But that alpha rotation is like our system for global macro. It's pretty cool. And while we're dealing with this market that's likely going to continue going lower from here, I would highly suggest checking out this video that we just did. Just released it. You can't get rich from stocks if you were born in this year. The title is whatever, but it's literally one of the most interesting videos I've made in a long time. And it shows you some real hard data of why you are likely mentally blocked. And we all are when it comes to the market. So once you see the data in that video, it's going to make things like what's happening in the market right now a lot easier to get through. But I'm going to put a link to that video right here. And I'm telling you, you're going to like it. It's along the lines of market psychology like we talked about in the previous videos. We're going to shift more towards that, right? Because during times like this, yeah, your psychology is the most important thing. As long as you got your system in place, which we always say with the risk management, of course. But other than that, it's all mental. So click this video right here and I will see you there.